You know what's funny about trading? Most people think they need to predict the market correctly to make money. They spend hours analyzing charts, reading news, watching expert predictions, trying to figure out exactly where the price will go next. And you know what happens? They burn out, lose money, and quit. Because here's the truth nobody wants to tell you. Being right about market direction doesn't guarantee profits, and being wrong doesn't guarantee losses. Yeah, you heard that right. You can be wrong more often than you're right and still walk away with consistent profits. Sounds crazy, doesn't it? But this is the reality of professional trading. And today, I'm going to show you exactly why your obsession with being right is actually holding you back from becoming profitable. Let me paint you a picture. Imagine two traders. The first trader, let's call him Mark. He's got a 60% win rate. Out of every 10 trades, he wins 6 of them. Sounds pretty good, right? The second trader, Sarah, she's only got a 40% win rate. She loses 6 out of every 10 trades. Most people would bet on Mark being the profitable one. But here's the twist. At the end of the year, Sarah has made $300,000 while Mark is down $50,000. How is that even possible? The answer lies in something called risk-reward ratio, and it's the secret that separates amateur traders from professionals. You see, Mark wins more often, but when he wins, he only makes $100. When he loses $500. He can't stand being wrong, so he holds on to losing trades, hoping they'll turn around, and he exits winning trades too early because he's afraid they'll reverse. Sarah, on the other hand, she accepts being wrong. When she's wrong, she cuts her loss at $100. But when she's right, she lets her winners run to $500 or more. Do the math. Mark wins 6 times at $100. That's $600. He loses 4 times at $500. That's $2,000 lost. His net, negative $1,400 per 10 trades. Sarah loses 6 times at $100. That's $600 lost. She wins 4 times at $500. That's $2,000 gained. Her net, positive $1,400 per 10 trades. This is the fundamental truth that most traders never grasp. Trading isn't about being right. It's about managing risk and reward so that your winners outweigh your losers even if you're wrong most of the time. The greatest traders in history understood this. Paul Tudor Jones, one of the most successful hedge fund managers, has said that his trading philosophy is to lose the least amount of money possible when you're wrong. George Soros, who famously broke the Bank of England, wasn't right all the time. He was just brilliant at cutting losses quickly and letting profits run when he had a good position. Let me tell you about Richard Dennis and the Turtle Traders experiment. Back in the early 80s, Richard Dennis was a legendary trader who turned $400 into $200 million. He had an argument with his partner about whether trading could be taught or if it was an innate talent. So they placed an ad in the Wall Street Journal looking for people to train. They selected 23 complete beginners, people with 0 trading experience. Dennis taught them a simple trend-following system. The rules were mechanical. Enter when price breaks a certain level, exit when it breaks another level, risk only a tiny percentage per trade. The system was right only about 40% of the time. But here's the kicker. Over the next 4 years, these turtle traders made over $100 million. Beginners, with a system that was wrong 60% of the time. The key was that when the system was right, they stayed in the trade and let it run. When it was wrong, they got out immediately with a small loss. They didn't try to predict if the market would go up or down. They just followed the rules. They accepted being wrong more often than being right because they knew their few big winners would more than compensate for their many small losses. Now let's talk about why people struggle with this concept. It goes against human psychology. We're wired to want to be right. When you tell someone you're wrong 60% of the time, they think you're a failure. Society values accuracy. In school, getting 40% on a test means you fail. At work, being right only 4 times out of 10 would probably get you fired. But trading isn't school or a regular job. The markets don't care about your ego. They don't reward you for being right. They only reward you for managing risk properly. There's also something called loss aversion. Psychologists have proven that humans feel the pain of a loss about twice as strongly as they feel the pleasure of an equivalent gain. This means that losing $100 hurts way more than winning $100 feels good. So what do traders do? They hold on to losing trades way too long, hoping they'll come back to break even so they don't have to admit they were wrong. And they close winning trades too quickly because they're afraid of losing the profit they've already made. This behavior guarantees failure in trading. Professional traders flip this script. They've trained themselves to cut losses quickly without emotion and to hold winners even when their brain is screaming at them to take the profit. It's uncomfortable. Every part of your psychology fights against it, but it's absolutely necessary for success. Let me give you another real example. There was a trader named Seykota who turned $5,000 into $15 million over 12 years. His approach? He rode major trends in commodities. He wasn't trying to pick tops and bottoms. He wasn't trying to be right about every little wiggle in the market. He waited for clear trends to develop. Then he got in and stayed in until the trend was clearly over. He once held a position in silver for months while it kept going higher and higher. Most traders would have exited a dozen times along the way, taking small profits. But Seykota understood that the big money isn't in being right often. It's in being positioned correctly when the big moves happen and staying positioned throughout those moves. Here's another mind-bending fact. Some of the most profitable algorithmic trading systems out there have win rates below 50%. There are trend-following funds that win on only 30 to 40% of their trades, but they've been profitable for decades. How? Because their average winner is 3 to 5 times larger than their average loser. They're designed to capture the big trends while taking many small losses during choppy markets. The system designers aren't trying to be right. They're trying to be present for the big moves and minimize damage during the times when markets aren't trending. Now let's address something important. I'm not saying accuracy doesn't matter at all. If you're right only 10% of the time, you'd need enormous winners to overcome all those losses, which is pretty hard to achieve consistently. What I'm saying is that once you're in the realm of 35 to 55% win rate, which is very achievable with a decent trading strategy, your success will be determined entirely by how you manage your wins and losses, not by improving your accuracy. Think about it this way. Would you rather have a strategy that wins 70% of the time but makes you $1 when right and loses $3 when wrong, or a strategy that wins 40% of the time but makes you $3 when right and loses $1 when wrong? The first strategy sounds better. You're right most of the time, feels good for your ego, but you'll go broke. The second strategy means you're wrong more than half the time, which stings emotionally, but you'll get rich. This is the choice every trader faces, whether they realize it or not. Let me share some practical aspects of how this works. Professional traders use something called position sizing. They risk the same small percentage of their account on every trade, usually 1 to 2%. So if they have a $10,000 account, they risk $100 to $200 per trade. This way, even if they have a string of losses, they're still in the game. They're not trying to hit home runs. They're playing for consistent base hits, knowing that occasionally they'll catch a big trend that pays for all the small losses and then some. They also use stop losses religiously. A stop loss is a predetermined price where you'll exit a losing trade no matter what. You set it before you enter the trade, and you don't move it unless you're moving it to lock in profit. This removes emotion from the equation. When the price hits your stop, you're out. No hoping, no praying, no convincing yourself the market will turn around. You accept you were wrong about this particular trade, you take your small loss, and you move on to the next opportunity. On the flip side, professional traders either don't use profit targets or they use very loose ones. They let the market tell them when the trade is over. Maybe they use a trailing stop that moves up as price moves in their favor, locking in profits while still giving the trade room to run. The key is asymmetry. They're willing to risk $100 to make $300, $500, or even $1,000. They stack the odds in their favor through risk management, not through prediction. Here's a reality check that might sting a bit. If you're obsessing over market analysis, trying to find the perfect indicator combination, backtesting 100 different strategies to find one with an 80% win rate, you're wasting your time. That's not where the edge is. The edge is in discipline, risk management, and psychology. You could give 100 people the exact same profitable trading strategy, and 90 of them would still lose money. Why? Because they can't follow the rules. They let emotions override the plan. They risk too much when they're confident. They risk too little or skip trades after a loss. They move their stops. They take profits too early. The strategy wasn't the problem. Their execution was. There's a famous quote in trading: plan your trade and trade your plan. Sounds simple, but it's incredibly hard to do. When you're in a trade and it's going against you, every fiber of your being wants to give it more room. Move that stop loss, because this time it'll come back. When you're in a winning trade, you start calculating how you'll spend the the profit, and fear creeps in that you'll lose it, so you exit early. These emotional reactions destroy profitability. The traders who make it are the ones who develop a trading plan with defined entry rules, stop-loss rules, and exit rules, and then they follow it robotically. Trade after trade after trade. They don't judge themselves on whether any individual trade wins or loses. They judge themselves on whether they followed the plan. Because they know if they follow a plan with positive expectancy, meaning the average winner is bigger than the average loser then, over a large number of trades, they will be profitable. It's just math at that point. Let me tell you about expectancy, because this is the metric that actually matters. Expectancy is calculated by taking your average win multiplied by your win rate minus your average loss multiplied by your loss rate. Let's say you win 40% of the time with an average win of $250, and you lose 60% of the time with an average loss of $100. Your expectancy is 0.4 times 250 minus 0.6 times 100. That's $100 minus $60, which equals $40. This means every trade you take has an expected value of $40. It doesn't matter that you lose more often than you win. Over time, you're making money. Now compare that to a trader who wins 60% of the time with an average win of $100 and loses 40% of the time with an average loss of $200. Their expectancy is 0.6 times 100 minus 0.4 times 200. That's $60 minus $80, which equals negative $20 per trade. Even though they're right more often, they're losing money over time. This is why accuracy is overrated. The beautiful thing about understanding expectancy is that it frees you from the pressure of being right. You stop caring about any individual trade outcome. You're playing a numbers game. You know some trades will lose, probably most of them, and that's fine. You're not trying to avoid losses. You're trying to make sure that when you win big enough that it more than covers all the losses. It's like a casino. The casino doesn't win every bet. They lose plenty, but the odds are slightly in their favor, and over thousands of bets, they're guaranteed to be profitable. You want to be the casino, not the gambler. Here's another psychological trap: recency bias. Humans put way too much weight on recent events. If you have 3 losing trades in a row, you start doubting your system, even if your system is profitable over 100 trades. If you have 3 winning trades in a row, you get overconfident and start risking more. Both reactions are dangerous. You need to think in terms of large sample sizes. Any trading system will have winning streaks and losing streaks. What matters is the overall expectancy over dozens or hundreds of trades. But our brains aren't wired to think this way. We react to the immediate past as if it predicts the immediate future. It doesn't. Professional traders keep detailed journals. They record every trade, not just whether it won or lost, but whether they followed their rules. They review their journals regularly to see if they're executing their plan correctly. They look at their statistics. What's their actual win rate? What's their actual average win and loss? Is their expectancy still positive? Are they following their rules, or are emotions causing them to deviate? This level of self-awareness and accountability is what separates consistent winners from everyone else. Let's talk about something else that trips people up: confirmation bias. Once you're in a trade, you start looking for information that confirms you're right and ignoring information that suggests you're wrong. If you're long a stock, you'll notice all the positive news and dismiss the negative news. This leads to holding losers too long because you're constantly finding reasons to believe it'll turn around. The solution? Make your decisions before you enter the trade. Decide in advance exactly where you'll exit if you're wrong, and exactly how you'll manage the trade if you're right. Then, once you're in, stop analyzing. Just follow your predetermined plan. There's also the concept of revenge trading. You take a loss, and it makes you angry or frustrated, so you immediately jump into another trade to win back what you lost. This is emotional trading, and it's a fast track to blowing up your account. Professional traders accept losses as a cost of doing business. They don't get emotional about them. They certainly don't try to win back losses immediately. They stick to their plan and wait for the next valid setup according to their rules. Something else worth mentioning is overtrading. Some traders think more trades equal more profit, so they take marginal setups that barely meet their criteria because they're impatient. But remember, every trade has costs: commissions, spreads, slippage, and every trade carries risk. If you're taking low-quality setups, your win rate drops, your expectancy drops, and you're probably losing money. Professional traders are patient. They wait for high-quality setups that clearly meet their criteria. area. They're happy to sit on their hands for hours or days if necessary. They know that fewer high-quality trades will outperform many mediocre trades. Now, I want to address the role of luck in trading because it's important. In the short term, trading results are heavily influenced by luck. You can do everything right and still lose money for weeks or months because the market isn't cooperating with your strategy. You can also do everything wrong and make money for a while because you got lucky. This is why people often conclude that trading is just gambling. They don't see that over large sample sizes, skill overcomes luck. A trader with a proper edge and proper risk management will be profitable over thousands of trades, even though they might have losing months or even losing years occasionally. The key is to make sure you have enough capital to survive the unlucky periods. This is why risking only 1 to 2% per trade is so important. If you risk 10% per trade, you can have a 10-trade losing streak, which isn't even that unusual, and you've lost your entire account. Game over. But if you risk 1% per trade, a 10-trade losing streak only costs you about 10% of your account. That's survivable. You're still in the game, and when your edge starts working again, you'll recover and move ahead. Let me wrap this up with the most important takeaway. Stop trying to be right about the market. The market doesn't care what you think. It's going to do what it's going to do, regardless of your opinion. Instead, focus on managing risk. Focus on making sure that when you're wrong, you lose a little, and when you're right, you win a lot. Focus on following your trading plan with discipline. Focus on thinking in probabilities, not certainties. Accept that losses are part of trading. They're not failures. They're just the cost of doing business. If you can shift your mindset from needing to be right to managing risk properly, everything changes. You stop feeling the pressure to predict the future. You stop getting emotional about individual trade results. You start seeing trading as a business where you have an edge that plays out over many repetitions. You become consistent. You become profitable, not because you're smarter than other traders or because you found some magic indicator, but because you understand the one thing most traders never figure out. You don't have to be right to be profitable in trading. You just have to be smart about managing the times when you're wrong and maximizing the times when you're right. That's the game. That's the secret. And now you know it.